Hi everyone, welcome to this class. In the last class we talked about cost of equity, where we give different formulas for computation of cost of equity. First one is DO into bracket 1 plus G, or the market value everything plus G. The another method of calculating cost of equity is what? D1, dividend year 1, or the market value plus growth. Another form is what is DO over market value. The last class we have explained how to compute all this and what we mean by all these formulas, what these acronyms here. This is dividend in year 0, the latest dividend, market value, growth, the growth rate, dividend in year 1, market value, and the growth rate, and so on and so forth. So, because as an investor, it tends to appraise our company which you have invested by the level of dividend in which they are paying. You need to pay us because we have different categories of investors. Those are which are income-based investors, and those are which are capital appreciation investors. The income-based investor, we tend to see how the company is able to make profit and pay them dividend at the end of the year. While the income-based investors are a set of people who appreciate, who like the company to do what? To grow. In order to do what? The market value of the company to grow, to grow up. But as the case may be, this growth we are talking about here is a growth in dividend. And when the examiner doesn't give you this growth rate, sometimes the examiner will give you the growth rate and dividend. But in case whereby the examiner does not give you the growth rate and dividend, how do you compute this growth rate that we are talking about here? So we have basically two methods of determining what the growth rate. The first one is what? Dividend valuation model. And the second one is what? Gordon growth model. These are basically the two methods of calculating our growth rates. So we are going to take it one after the other now in order to see how we can use either of these methods to do what? To calculate our growth rate. And besides, it will depend on the information given to us in the question that will tend to lead us, that will tend to tell us which of these formula we are going to use to determine our growth rate. Are we using dividend valuation model or are we using the Gordon growth model? So we shall look at it in details now in order to know which method to use when you are being faced with the computation of what? Of the growth rate. Having said that, so let's look at this one after the other. The dividend valuation model. 1. Dividend valuation model. Dividend valuation model. The formula here is root n latest dividend, latest or current dividend, all over base year dividend. Everything minus 1. Mind you, this square doesn't cover this minus 1. Everything minus 1. Or the formula, another formula for calculating the dividend valuation model is what? N minus 1. Mark you, this n is what is inside the square root. So n minus 1, latest dividend, or current dividend, as I said it. Current dividend over what was base year. Base year dividend. Everything minus 1. Now, these are basically the major subdivision of what? Dividend valuation model. And here, the next question to ask ourselves is, when are we going to use this formula and when are we going to use this formula? When are we going to apply this formula? How do we know which of these two formulas to use in a particular question? This is the tune of the question that will enable us to know which particular formula to use in the question. In this scenario, if dividend given to us is related to a specific year, take for example, under this formula, so for us to use this formula, the question will tell us so dividend, a particular dividend was paid in 5 years ago, as the case may be, or 2 years ago, where you are given a specific year in which the last dividend was paid. So take for example, the question told you that what? Dividend of 50 kobo was paid 5 years ago, and the current dividend is 70 kobo. In that wise, this is the formula we are going to use. How are we going to know which formula to use again? We are going to use this n roots. This particular formula, n roots, root n latest or current dividend be over base year dividend minus 1. If the year in which the last dividend was given to us, say for example, dividend paid 5 years ago. As if dividend paid 5 years ago, dividend paid 5 years ago is equal to 50 kobo, and the current dividend is equal to 70 kobo. You can see we are specifically given that this dividend, this was the dividend paid 5 years ago, and this is the current dividend paid. In this wise, this is the formula we are going to use. But in a case whereby we are not given in this form, and we are given the dividend paid in a tabular form, let's say for example, dividend paid over 5 years. Let's say year 1, year 2, year 3, year 4, year 5. As the dividend paid in year 1 was how much? 20 kobo. Dividend paid in year 2, say 20 kobo. 20 kobo. Dividend paid in year 2, 30 kobo. Dividend paid in year 3, 35 kobo. Dividend paid in year 4, 40 kobo. Dividend paid in year 5, let's say 50 kobo. In this case, we can see that the dividend is given in what? In tabular form. If the dividend is given to us in tabular form, like this is the formula we are going to do or we are going to apply. And n is what? N is the number of years. N is what? The number of years. So the total number of years here is what? Is 5. So therefore, n is what? Number of years, which should now be what? 5 minus 1. In this case, the number of years in this case is what? Just 5 straight away. Just making it what? 5 straight away. That's the number we're going to use here. Because we are given a specific number of years. But in this case, in which you have in tabular form, that it will now be what? N, which is 5, minus 1. And that's it. So these are the scenarios in which you are going to use either of this formula or this formula. Now let's now look at the second formula, which is what? Gordon growth model. Gordon growth model. The Gordon growth model estimates estimate his own growth rate to be what? Say his own growth rate is what? RB. which is what? R times B. What is R? R is equal to rate of return. Rate of return. Like rate of return on investment or return on investment. YB is equal to retention rate. This is how I'm going to do is compute the growth rate using the Gordon growth model, where R is what to return rate of return. And this rate of return on what to on your investment. YB is equal to retention rate. Retention rate, this is the retention rate in which the company, this is a portion of the profit made by the company in which the company retained for business expansion. When we say retention rate is a portion of the company's profit for the year in which the company retained for business expansion. Take for example, after you have calculated, you have completed your what? Your profit for the year. So you have paid all other expenses, you are now left with net profit. So you are going to, so let's say the company pursue a policy of what? Of retaining 30%. 30% of this what to always profit after the year, before now to be after the year. So this is the rate of retention which we are talking about. So it's going to retain this 30% before proceeding to paying what? Before proceeding to do what? To pay dividend. So in this scenario, these are the cases in which you can do what? Which you can be facing when computing what? Dividend, the growth rate, dividend growth rate. So another question to ask is that, how do we now know whether we are going to use the Gordon growth or dividend valuation model? It is the tune of the question that's going to tell us which of these formula to use, as I said earlier. Whereby you are given what? The retention rate and the rate of return. Definitely you should know that we are going to do what? We are going to use the Gordon growth model to calculate our growth. But in a case whereby we are given the first scenario, whereby it gives you what? Dividend paid 5 years ago and the current dividend, it means we are going to use what? The dividend valuation model, in which the, going back to the table I started earlier, which I said year 1, year 2, year 3, year 4, year 5. So 20 kobo. This is the base year dividend. Why? This is the current year. Let's now say this one is 50 kobo. This is the current year dividend. So it will now be n, as the case may be, n minus 1, or n, the current dividend is what? Is 50 kobo a year. While the base year dividend is what? Is 20 kobo. Everything minus 1. So we then do your computation and what? And get a growth rate in which you are going to use in your what? In your formula. In which you are going to use in the computation of what? Of cost of equity. So this is the explanation regarding the computation of the growth rate. This is the explanation concerning the computation of growth rate. So in subsequent videos, shall be using figures in which we are going to do what? To compute dividend growth rate. In which you are going to do what? To compute dividend growth rate, in which you are going to use in the computation of what? Of our cost of equity. So therefore, watch out for our next video to see the computation and subsequent discussion on cost of equity. Thank you.